Hello, this is TQQ Labs 68, $1 billion. That's how much NVIDIA reported in revenue for a single quarter after the close today. No semiconductor company in history has ever generated that kind of revenue in one quarter. But there's an even more staggering number. Next quarter's guidance, $78 billion. Wall Street expected $72.6 billion. NVIDIA topped that by $5.4 billion. The moment Jensen Huang dropped that number, NVIDIA's stock shot up to $206 in after-hours trading, a new all-time high. But then something strange happened. That 216 came back down to 196. Record-breaking earnings, record-breaking guidance, and the stock barely moved. Nasdaq futures actually slipped 0.3%. What happened? Let's break it all down. First, let's establish what NVIDIA actually is. If you're holding TQQ, you probably know this already, but for anyone new to the channel, here's the essentials. NVIDIA's annual revenue is $215.9 billion. Look at the revenue breakdown and everything becomes clear. Data center accounts for 88.3% of total revenue. Gaming is 8.7%, professional visualization 1.4%, automotive 1.3%. NVIDIA is, for all practical purposes, a data center company, making AI chips and selling them to Google, Microsoft, Amazon, and Meta. That's essentially the entire business. Here's the thing. That data center share was only 55.5% just 3 years ago, in fiscal year 2023. In 3 years, it went from 55% to 88%. Over the same period, data center revenue itself exploded from $15 billion to $193.7 billion, a 13x increase. No company in history has grown revenue at this pace. That's the first key to understanding NVIDIA. The geographic breakdown is equally interesting. The US accounts for 46.9%, nearly half. Then Singapore at 18.1%, Taiwan at 15.8%, and China at 13.1%. China is the one to watch here. Despite US export restrictions, China still represents 13.1% of revenue, $17.1 billion. That's up 66% from $10.3 billion a year ago. Revenue actually grew despite export controls. However, NVIDIA's management made a telling comment on the earnings call. The H200 product has been approved, but no revenue has been generated yet. The latest Blackwell chips remain blocked from export to China, and the fallback H200 has only been approved, no actual sales yet. In the Q1 guidance, management explicitly stated they did not assume any data center compute revenue from China. That $78 billion guidance has zero China baked in. That's a risk, but flip it around, and the moment China opens up, it becomes explosive upside. Now let's get into the heart of today's earnings. Q4 revenue, $68.1 billion. Beat Wall Street consensus of $66.2 billion by 2.9%. Earnings per share came in at $1.76, crushing the estimate of $1.52 by 15.8%. Revenue beat, earnings beat. That makes 7 consecutive quarters of earnings surprises, 7 straight. NVIDIA hasn't missed Wall Street estimates a single time in the last 2 years. Net income was $42.9 billion in a single quarter. For the full year, $120.1 billion. To put that in perspective, NVIDIA's quarterly profit alone exceeds the entire annual operating income of most major corporations. Now for the most important part, guidance. Q1 revenue guidance, $78 billion plus or minus 2%. Wall Street consensus was $72.6 billion. That's a $4 billion beat, 7.4% above expectations. This was the real highlight of the earnings report. Earnings are backward-looking numbers. What the market truly cares about is the forward outlook. NVIDIA declaring we'll generate $78 billion next quarter is proof that AI demand hasn't flinched. If $78 billion materializes, that's 69% year-over-year growth. Projecting nearly 70% growth at this scale means this AI cycle is still in its early innings. Let's hear directly from Jensen Huang. Computing demand is growing exponentially. The inflection point for Agentic AI has arrived. Agentic AI, that was the defining phrase of this earnings call. Agentic AI means AI that doesn't just answer questions, but autonomously reasons, decides, and acts. Not a chatbot, an agent that schedules meetings, sends emails, writes code, and analyzes data on its own. Jensen declared that the inflection point has arrived and that enterprise adoption of agents is accelerating rapidly. Why does this matter? Agentic AI drives inference computing demand exponentially higher. Training is a one-time event, but inference happens every single time the AI is used. For agents to autonomously perform tasks, GPUs need to be running at every step. In Jensen's words, computing is revenue in this new industrial revolution. When customers buy GPUs, those GPUs immediately generate revenue. AI infrastructure isn't a cost, it's a revenue-generating tool. That's why investment will keep flowing. Following the successful mass deployment of Blackwell, the next generation has arrived. Vera Rubin. Sample chips shipped this week, with mass production starting in the second half of the year. Vera Rubin cuts inference token costs to 1/10 of Blackwell's. It can train mixture of experts models with 1/4 the GPUs. AWS, Google Cloud, Microsoft Azure, and Oracle will be the first to deploy Vera Rubin. Jensen said, every cloud model builder will deploy Vera Rubin. This reveals NVIDIA's strategic brilliance. They've mass-deployed Blackwell while already having the next generation ready. Customers can buy Blackwell now or wait for Vera Rubin. Either way, they're paying NVIDIA. This is the platform lock-in strategy. Blackwell sits on top of the CUDA ecosystem, and Vera Rubin sits on top of that. Once you're in, it's very hard to get out. A strategic investment was also announced, a $10 billion investment in Anthropic, the company behind Claude. Anthropic will train and run inference on Grace Blackwell and Vera Rubin systems. The earnings call mentioned that Meta and Anthropic are scaling to millions of Blackwell and Rubin GPUs. Millions. The scale is in a different league entirely. Now let's look at the market reaction. In Wednesday's regular session, NVIDIA closed at 195.56, up 1.41% on the day. Regular session volume was 1.696 billion shares, more than triple a normal day. Everyone was waiting for this report. A third of that volume was concentrated between 1 and 2:30 p.m. Eastern, investors positioning ahead of the earnings release. Then after the close, the numbers dropped. In after-hours trading, NVIDIA surged to $206.73, a 5.5% spike from the closing price. It briefly broke through $200 for a new all-time high. But then what happened? It came back to $196. It even dipped as low as $190.84 before recovering. The after-hours range between the high and the low was $16, an 8% swing. Why did this happen? Two reasons. First, Salesforce. At the same time, Salesforce also reported earnings. Their fiscal year 2027 revenue guidance came in at $46 billion, below market expectations. Salesforce stock dropped 5% in after hours. Salesforce had positioned itself as the poster child for AI-powered enterprise transformation. AI agents revolutionizing business. When that company's guidance disappoints, it puts a question mark on whether AI is actually translating into revenue. NVIDIA sells the shovels. Salesforce is supposed to dig the gold. The shovel seller is printing money, but the gold digger can't break even yet? That disconnect rattled investors. The 0.3% dip in Nasdaq futures wasn't because of NVIDIA. It was because of this structural question about AI investment versus monetization. Second, the weight of expectations. NVIDIA trades at a PE of 39.6x. AMD is at 79.3x, Broadcom at 68.1x. By the numbers, NVIDIA is actually cheaper than its competitors, with 65% revenue growth and a 39.6x PE. The PE ratio is 1.8, lower than AMD's 2.6. But the market has already priced in this growth. After 7 straight earnings beats, the market assumes, of course, they'll beat. Beating consensus by a little is expected. The question becomes by how much. This quarter's revenue surprise was 2.9%. Last quarter it was 3.7%, before that 1.5%, before that 1.7%. The surprise margin is narrowing. The absolute numbers are all-time records, but the degree of outperformance is shrinking. That's the second reason for the lukewarm reaction. Let's go deeper. Data center revenue. $62.3 billion, up 75% year over year, up 22% quarter over quarter. Break this number apart and the structure reveals itself. The top 5 cloud providers, Amazon, Microsoft, Google, Meta, and Oracle, account for roughly 50% of data center revenue. The other 50% comes from everyone else. This matters. NVIDIA's customer base isn't dependent on just 5 big tech companies. It's diversifying. Sovereign AI is an especially notable new growth driver. Nations building their own AI infrastructure. Saudi Arabia, the UAE, and European countries are constructing independent AI clouds to secure data sovereignty. Sovereign AI revenue has surpassed $30 billion annually, a 3x increase year over year. Even if big tech capex cools off, this nation-level demand acts as a safety net for NVIDIA. We need to look at the competitive landscape. On Monday, Meta signed a $60 billion AI chip supply deal with AMD, a 5-year, 6-gigawatt commitment. AMD stock jumped 8.77% in a single day. Headlines screamed that NVIDIA's dominance is cracking. But the moment NVIDIA's earnings dropped after the close today, AMD fell in after hours, from a regular session close of $210.86 down to as low as $193.70, an 8.1% plunge. NVIDIA's results were so strong that AMD's relative appeal actually diminished. The numbers tell the story. NVIDIA's revenue growth, 65.5%, 30.3%. NVIDIA's operating margin, 64 and 10.7%, a 6-to-1 gap. NVIDIA's net margin, 55.6%, 12.5%. For every dollar NVIDIA earns, 56 cents flow to the bottom line. For AMD, it's 13 cents. Same industry, but the profitability gap is staggering. Yet NVIDIA's PE is 39.6x, while AMD's is 79.3x. AMD is twice as expensive. Slower growth, far lower margins, but a higher multiple. That either means AMD carries enormous expectations or NVIDIA is significantly undervalued. So how should we interpret the Meta AMD $60 billion deal? It's less a threat to NVIDIA and more evidence that the AI infrastructure market itself is expanding. A bigger pie naturally attracts more players. But has NVIDIA's share of the pie actually shrunk? Data center revenue growth of 75% answers that question. Even with competitors entering, NVIDIA's slice keeps getting larger. Now let's connect this to TQQQ. NVIDIA is one of the largest weights in the Nasdaq 100. Where NVIDIA goes, QQQ follows, and TQQQ is 3 times QQQ. In Wednesday's regular session, QQQ rose 145%, while TQQQ gained 4.2%. That's the power of leverage. But with Nasdaq futures down 0.3% in after hours, that move will be reflected when the market opens Thursday morning. Let's step back and look at the broader picture. QQQ's 200-day moving average sits at 585. The current price of 616.68 is 542% above the 200-day line. The 100-day SMA is at 640. QQQ is sitting right on top of it. RSI is 57, squarely in neutral territory, neither overbought nor oversold. QQQ's monthly return is minus 151%, year-to-date plus 58%, essentially flat for the year. TQQQ is minor 5, 86% for the month, 92% year-to-date. Leverage amplifies the downside. Let me bring this together. NVIDIA's Q4 earnings were objectively dominant. 68. $1 billion in revenue, 73% growth, a 15.8% EPS surprise, and $78 billion in Q1 guidance. 7 straight quarters beating Wall Street. Blackwell is ramping successfully, and the next generation, Vera Rubin, is already in motion. A $10 billion investment in Anthropic, $30 billion in annual sovereign AI revenue, and the CUDA ecosystem moat keeps deepening. But the market's response was cold. After hours hit $206, then faded back to $196. Nasdaq futures slipped 0.3%. 7 consecutive surprises have created an expectation inflation that makes it harder for even stellar results to move the stock. Salesforce's guidance miss dragged the structural question of AI monetization right back to the surface. Nobody can predict exactly what happens when the market opens Thursday, but the data tells us a few things. NVIDIA's fundamentals are the strongest they've ever been. A 39.6x PE is far from expensive given the growth rate. However, market breadth is narrowing, with increasing dependence on a handful of names. When you're holding a leveraged ETF in this kind of environment, the key is trusting your system. Decisions based on data, not emotions. Not getting euphoric on the way up, not panicking on the way down. QQQ is 42% above its 200-day, sitting right on the 100-day. RSI at 57, technically healthy. VIX at 7.9 signals relative stability. In these conditions, what we do is clear. Follow the system. Thursday's session will deliver the market's regular hours verdict on NVIDIA's earnings. After-hours volatility was significant, so the regular session confirmation is what matters. As this video has shown, when you break down the numbers one by one, there's no reason to let emotions take the wheel. Data doesn't lie. We break down the numbers like this every single day. In the next video, we'll review Thursday's session, what NVIDIA's earnings actually did to the Nasdaq and TQQQ once the dust settled. If you don't want to miss it, subscribe, like, and hit the bell.